Hi, thanks so much for joining in. This is the Mutual Fund Show, and I'm Alex Matthew. This show gets you actionable insight on everything mutual fund related. The strategies that we're talking about today, though, have beaten the benchmark quite consistently. In fact, several benchmarks quite consistently over multiple years, and possibly quite a few actively managed equity schemes as well. And that's particularly on a post-cost basis. But they're not widely adopted. We're going to talk about what these strategies are and whether you can adopt one of them or in fact a combination of 3 or 4 of them. And we're also going to talk about why they're not more popular, especially because they've consistently beaten the benchmark. Joining me to talk about it is Pratik Oswal, the head of passive funds at Motilal Oswal AMC. Pratik, thanks so much as always for taking the time. This isn't a new concept, and in fact, I recall a conversation several years back before you even launched some of these strategies at Motilal Oswal, where you were talking about the potential for factor investing. So first, let's establish for those that are unfamiliar with factor investing, what is this all about? How do you explain this concept?
Hi, Alex. Thanks for inviting me. Looking forward to this conversation today. I think we spoke about factor investing a few years ago. I think we talked from the lens of how important it's become over the globe. If you look at the size of factor investing, it may not be very popular today in India, but if you look at the global landscape, after say the broad-based funds in the US, like the S&Ps or the Nasdaqs, the second biggest category in the world is actually factor investing. Approximately $4 to $5 trillion of wealth is currently being invested in factor funds. And obviously in India, it's been slow growth, but we see huge opportunity for this segment coming in over the next 4 to 5 years time. So that's essentially just a broad landscape of how large it is. But essentially, what factor investing is basically you're basically investing in a particular strategy. A lot of investors today who tend to buy stocks, tend to use certain filters. They tend to use filters like debt to equity or profit margin, or they tend to use which are grouped into the to the category called quality. Also, a lot of investors look at growth statistics, right? How has the stock price moved over the last 1 year, 2 years, 3 years. So if you look at a lot of these filters, today investors can actually buy this through factor investing. There are a lot of factor funds today which offer these strategies in the form of a simple plain vanilla index fund or an ETF. And essentially, you can access these strategies that a lot of fund managers use through factor funds. And what we've seen in factor funds is that not only in India, but also globally, if you look at the 4 most popular factor funds, you have momentum, value, quality, and low volatility, which we can go into details. All 4 have outperformed their respective benchmarks over 4 to 5 decades. In India, obviously, factor investing is very early days. But if you look at the 4 indices, what we've seen is that all 4 of these popular indices, have all beaten the benchmarks thoroughly over
And that's the proof of the pudding, right? That's the proof of the pudding, which is that, on paper it looks well and good, but if you scroll back all the way for the last 15 years, and I see the graphic in front of me, if you're looking at a value strategy, it's given you what, 19.7% 15-year CAGR, CAGR, compounded annual growth rate. Something like a momentum has given you 23.4% as of the end of 2023. Similar return for quality, 23%. A low vol strategy has given you 21%, and a Nifty 200, which is a broader gauge than you would normally look at, which is still broadly large cap, but it's broader than your Nifty 50. It's only given you 17% compounded annual growth rate. It's nothing to scoff at, nothing to sneeze at, but these factors have handily beaten the benchmark here. So let's talk about why they're not popular first, and we'll delve then into what you need to bear in mind as an investor. Pratik, you've been speaking about this, I guess, to a certain extent. You've been evangelizing this as well. You've been telling people about it. Why would you say that it's not as popular as it should be?
Even if you look at index funds, ETFs, when I first started talking about index funds, ETFs, even with on your shows, it was a very niche market. I think a lot of people, even though index is very well covered and researched and bought all over the world prior to 2018 or 19, not many people knew about it. So I think the lack of awareness is something which is a big factor towards why at least factor funds have not really gained ground. And we see now over the last couple of years that there is a lot more sort of action and also more interest coming in factor funds. So I think lack of awareness is a key thing. There's not a lot of products in the space in factor funds. Just 2 years ago, there were maybe two or three factor funds. Today, you have around maybe 15, 20 factor funds in the market. So I think it's a combination of, I think a lack of awareness and also obviously lack of funds in the space. The third reason I say is also because, a lot of investors tend to see factor funds as very complex. In the US, even though factor funds is the second biggest category, after broad-based funds, it's not really talked about because it's very advisor driven, so because it requires some level of expertise to retail investors to understand. So I think that's the one more reason, which obviously will happen as more and more education happens in the space.
Would it also be a factor of, and forgive the use of the word, of the fact that a lot of the products that are consumed in the mutual fund space currently, Pratik, are sold rather than bought, and it is about what the distributor community is selling. Is that also something to bear in mind?
I think that was the case about 5 or 6 years ago. But I think direct investing has grown exponentially, I would say, in India since maybe COVID. I think the amount of new investors coming in who are directly going out there and buying mutual funds is a huge component. I think even in our AMC, I think maybe a third of our flows come from direct investors. So I think there is obviously a higher component of direct investors coming in, but I do feel that any fund that gets traction requires I think some level of track record. And I think in factor funds specifically, there's not a lot of funds who have a track record of more than 3 years time. So I think as and when these funds turn 5, 7 years, that is when these funds will pop up on people's radars, and that is when they start investing in this. So I think it's more lack of track record is what I believe is the main reason, at least at this point.
Okay, and a lot of these strategies are only about 3 years old, but they have, even in that period, they've outperformed, haven't they?
Yes, they have. Yeah. So I think we launched them about 2 years ago. But yes, I think the strategy. So if you look at the index strategy, one obviously is the index performance, which goes back towards 15, 20 years. The second one is the actual fund performance, which is after the fund starts getting launched. So I think when it comes to index funds, I don't think the fund performance is as important because obviously it's going to replicate an index. So the track record is obviously a lot more important. But yes, I think from a customer lens, customers do like investing in products that have a minimum track record of 3 to 5 years time. So yes, I think these things will obviously I mean, currently the space is very empty. There's maybe about two or three funds, but now since there have been a lot of launches over the last couple of years, you see these things sort of kicking up in the future.
Let's delve a little deeper into each of these strategies so my viewers can understand how to approach them, right? And then we'll possibly talk about combinations down the line as well. But let's start with value, which over the last 3 years, 21, 22, 23, has outperformed quite significantly. In 2023, it gave a return of 62.2% or thereabouts. What does this strategy entail, and why did it outperform in those 3 years?
Yeah, so it's very important to understand that these factor funds are passively managed funds. So there is no stock picking involved when it comes to choosing a value factor versus a lower factor. So these are all rules-based funds, and these rules are completely transparent. Unlike a lot of quantitative funds where the rule is hidden, investors who buy and end up buying these factor funds, are buying that underlying rule. So, for example, in the value fund, for example, the rule is you're essentially, selecting 30 stocks out of a universe of 200. So out of the Nifty 200 universe, you're essentially buying 30 stocks, which are the cheapest in India. So cheapest in the sense of price to earnings, price to book. They use these two, factors to sort of select the stocks. So the reason why value has done well in the last 10 years, last 3 years at least, is because we've had a huge and value is one such factor which is the most tricky because I think it's one factor that does extremely well in short bursts of time. And I think last 3 years were that short burst of time which values done well. But essentially, you're looking at the entire PSU rally that has happened over the last 3 years because of obviously they were cheap, but also obviously because they've had a huge turnaround in business models over the last 3 years. And also, I think that the government has put a lot of impetus towards improving them and professionalizing them and all of that. So I think the entire PSU rally has done wonders, for a lot of investors. And I think that has been captured really well in the value strategy because they tended to be the cheapest stocks 3 years ago, and they still are the cheapest stocks today, even after the entire sort of rally that happened in the last 3 years. So that has been a standout fund, I would say, in our portfolio. But what's funny is when we launched the fund in about 2 years ago, it was actually underperforming the benchmark for about 10 years.
Okay.
So when we had launched it, I think we had a lot of negative publicity back then. But then the idea was we want to keep building blocks for asset allocations. We want investors to choose whatever they fund they like in that category, and value is an important category globally, which is what the reason why we launched it. But again, very important factors are not strategies that consistently outperform every single year. And different factors work in different times.
Speaking,
Value as a factor, as you said, works tremendously well in a recovery sort of a market. After a crash. So post COVID, obviously, value's done well. Post financial crisis, value did really well.
yeah.
Even early 2000s, when you had a small sort of crash in 2013, value did very well. So I think
Yeah.
these are the sort of time periods when value does very well.
Let's also talk about something that got some investor attention over the last couple of years, simply because of and particularly last year, simply because of the kind of outperformance it generated, right? Momentum as a strategy, and that's I looked at a graph as well that you pointed out, not graph, but a visual depiction of when these factors do well. Momentum does
Yes.
well in an upcycle, in a bull run. Whereas low vol does well when it's sideways movement, value does well when it's a recovery phase, as you pointed out. But how does momentum work, and why has it gained so much traction? As you pointed out, it's because people are seeing that there is a benefit to holding it.
Yeah, so momentum. It's an excellent factor. Honestly, if you look at the factor that has done the best globally, it has been momentum, not in India but also in other geographies. And what's funny is it doesn't really work. I mean, it works in equities, but also it works in other asset classes. And it's also one of the simplest strategies to invest in. So I think, and what momentum is, basically you're buying stocks and securities that have had recent price momentum. So the stocks which have done the best in terms of price performance in the last 6 to 12 months is what chosen in your portfolio. It's a very simple strategy, and I think that has done extremely well for a lot of investors over over many years. The reason why momentum is a very good strategy is because it does well in bull markets. In sort of trending markets, and because bull markets tend to be approximately most of your, if you look at history of Indian capital markets, at least last 2 decades, bull markets are the longest out of the bull bear in recovery. So I think momentum as a strategy does very well in trending markets, and we are obviously in a trending market for many years now. So I think that's what it's done really well. I mean, psychologically, the reason why momentum does really well, and this is again interpretation, is that you tend to get into something which is trending before the crowd comes in. So I think if you look at most people today, they would buy into stocks that have already run up. Most people are looking at PSUs today. Most people are looking at stocks that have already been run up for about 2 years, whereas momentum comes in much early. And then also when momentum peaks, it's when you exit the stock.
Okay.
So I think that's why one reason to why it works really well. It really takes advantage of crowd psychology, which normally moves in much later than these strategies.
Pratik, we covered value and we covered momentum. There are a couple more. There is quality and there is low vol. How would you describe these two factors, and what is the primary objective of them?
Yeah. So, I think these strategies are, I would say, in terms of risk characteristics, fairly similar. You're essentially, so let's talk about low wall first. So actually, low wall is the largest bot factor globally. I think it's the most popular one globally. If you look at global I think and the reason why it's popular is because it's basically essentially buying a fund which is essentially you're picking stocks based on the lowest price volatility. So essentially, the most stable companies come into a low vol fund. So essentially, non-cyclical companies, consumer, healthcare, these sort of companies are very popular in low vol fund. The reason why low vol does well is because it does extremely well in the bear market. When the market crash happens, money tends to move towards stocks that are extremely stable, business models are good, works well in bull and bear conditions. So I think low vol tends to fall a lot less, and returns are asymmetric. So on the way up, a low vol fund has to do a lot, um, um, has to do less well for it to outperform. So I think low vol is an extremely good strategy for anyone looking at a very stable fund in the portfolio, very good balance sheets, business models. So that's low vol. The fourth one is quality. And this factor is again a little bit subjective because it looks at the Nifty 200 universe and selects the 30 companies that have the best quality. And quality is not subjective; it's objective. They look at stuff like debt to equity ratio, return ratios, and also profitability. So based on these three, they would select the top 30 stocks in the Nifty 200 universe. Essentially, again, very similar, does extremely well in bear markets because you're essentially buying quality companies. What's important with these two factors is that they actually sort of underperform in bull markets. So investors who are looking to invest in these should expect that because I think quality companies tend to be priced well, or you really have the cyclical companies who are doing well in the bear market. But across market cycles, what we've seen is that these strategies are extremely stable and do really well in terms of outperformance.
Yeah, because downside protection as well, I think people don't give it enough credit. You're protecting the downside, and therefore over a period of time you're outperforming. Having said that, it's difficult to time the market, and that's evidenced by absolute veterans in the space saying that it's absolutely impossible to do. You're either lucky or you're incredibly gifted. And if you're neither of these two things and you still need to make a little bit of money in the markets, then you need to choose what your strategy is. Can you do that based on your interpretation of where the market is at, bull, bear, recovery, or is it better to look at combinations?
Yeah, so factors work in different market conditions, so that's something which we can say very confidently. But I think trying to time the market is something which is extremely tough. We don't recommend, or we don't ask investors to say that. I think you can use a combination of factors, or you can. So if you have a very long term horizon, say maybe 5-7 years plus, then honestly it doesn't really matter. You go with the factor that you're most comfortable with in terms of investing it. You could look at a combination of factors. We've done a ton of analysis that's just looking at combining 2 or 3 factors and building a portfolio out of it. That tends to do really well across different market conditions. Some analysis I've also shared. The third is again to really look at what your risk profile is. So if you as an investor really feels that the markets are overvalued, or you want to invest in markets but you want to invest in something which will give you downside protection, then maybe a low vol does extremely well. Or if you're an investor who really wants to take advantage of the bull run, or you expect bull run to continue for the next 3-5 years, then a momentum can be a very good strategy. So I think based on your expectations and risk profile, you can look at you using factors in your portfolio. A lot of our investors are also using factors to minimize risk or maximize risk in your portfolio. For example, you have a very large allocation to small cap fund, like a small cap sort of side of the market, and you want to lower your risk profile of your entire portfolio. Then just having a low vol fund or a quality fund, maybe a 20% allocation, can really pull down the entire portfolio, volatility in a very big way. So I think those are some of the ways in which customers are using it. But as you said, timing is something which is not only difficult, it's impossible, and I haven't met anyone who's done it consistently well. So I think having it as a strategic allocation in your portfolio makes a lot more sense for most investors.
So you've got vested interest, Pratik, because you're heading passive. But I've spoken to a lot of advisors, and they've said that while this should be part of your portfolio, they say that you should have a tactical allocation towards these factors rather than employing them whole hog. Two-part question here. One, if you're looking at these, and I've been talking about them beating the benchmark, but can you really compare some of these factor strategies with actively managed funds, like to like? And also, where does it fit in your portfolio? Can you adopt just factors along with passive as a strategy?
Yeah, so I think that's a, that's a good question. So I think when it comes to factors, what's also important is factors tend to be mostly large caps. And I think if you ask a lot of advisors, the large caps tend to be the most popular when it comes to your broad-based index funds like Nifty 50 or Nifty 500. So, a lot of our advisors and distributors are using factors to plug in the large cap allocation where they feel, which factor will do well depending on their client risk appetite and all of that. So I think the large cap allocation, you could look at a combination of Nifty 500 and a factor fund that could really plug in your large cap allocation. And when you're looking at a mid and small cap, you're looking at actively managed strategies, which have done really well. We've seen, at least the statistics show, that mid and small is an area where there is a lot of opportunity to create a lot of wealth through active management. So I think that's how at least we would recommend this. I would say that yes, you could also look at it tactically as well. As I said, customers who are wary of the valuations or wary of the markets today could look at a much simpler say a low vol or low quality fund to make sure that they're invested but also they're protected in case markets fall. I think the beauty about factors is that you really know how it would react in a certain market condition. Whereas you can't really say how a specific actively managed fund would do in a bear market or a bull market or a recovery market. So I think even though there is underperformance, you have a reason why it's there, and which is why I think it's much easier to hold on, or it's easier to have more conviction on factor funds during periods of difficulty.
So the reason I ask about that is, at least hypothetically, at least on paper, and this is all back tested, an equal allocation towards these four factors over the past 12 years has given me about, what, 18% or thereabouts CAGR over that period. The Nifty 50 has given me less, and in fact the small cap index is more or less at par with this from what I looked at. So there is a strong argument because it's giving you the best of both worlds. You're looking at upside potential in the form of your momentum, and downside protection in the form of low vol and quality. So why not adopt this whole hog?
Yeah, I would agree. I think by combining factors, you are essentially taking out that, not underperformance risk, but you're taking out the risk of it doing badly in different market conditions. You're essentially having a factor that works in every market condition. And by rebalancing it, say a yearly or every couple of years, you're ensuring that the risk levels in your portfolio are pretty much the same. So, in fact, what we've seen is that by having an allocation towards four factors, all four equally weighted, there's no rebalancing required because the factors work in different market conditions. So essentially, you can just run with it for a very, very long time. So I think we are obviously big proponents, of a strategy that combines factors. You're basically essentially taking out, periods of stress by having exposure towards multiple strategies. That does well in different market conditions. Also, what we've seen is that the factor strategies are extremely different from a lot of the actively managed strategies in terms of, stock selection, asset allocation. Most of the funds tend to be slightly more value or quality oriented, whereas by factors you can get access to different strategies like momentum and low vol, which may not be as prevalent in portfolios than you would. So I think it adds a very different component to your overall portfolio.
Absolutely. Pratik, thanks so much for taking the time and for explaining all of that to us. And viewers, do bear in mind, of course, that this is something that you have to look at from the lens of passive investing, and also the cost is a benefit there, more or less comparable to passive investing costs. So the total expense ratio on some of these schemes that we've been talking about is around 0.4% for a direct scheme. And it is much higher for active, but there are proponents of active as well. We're not saying that active is not the strategy that you should employ. It's something to consider, though, whether or not you should add something like this to your portfolio. If you've got questions for us, send them to us on that number that you're seeing on your screen right now. And do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.